to Random Gleanings. Thanks for watching. Thanks to our new subscribers. We appreciate y'all. Jesse, last week we talked about inflation. We talked about what that means for stocks. Why don't you kick us off?
Yeah, well, real quick, let's set the backdrop here before we get into maybe the hyperbolic fear of inflation. But because right now in the market, we're in the middle of earnings season, and earnings have come in strong, actually, historically strong, with 80% of companies beating, with an upside surprise of about 7%. And normally, I think the company's beating is around 75 in the last 5 years. That's been the average.
It's pretty good.
Next chart, corporations are flush with cash.
Yes, they are.
We've heard in some earnings calls, they're going to use some of that cash to buy back stock. That's excited some investors as well. Why would they be holding so much cash? Well, next chart. This is the first time in at least the last 40-some years that when interest rates, or the Fed has increased interest rates, net interest expense has actually gone down.
Yeah, and so the way that happens is, everybody followed the CFO from Apple's lead back in the 2010s decade and issued a bunch of bonds at cheap rates, right? And now you've got, so their costs are fixed on that. But now you've got them with their cash portfolio earning 5.25%, 5.5% on cash. So yeah, they're really flush. In fact, they're as flush as they've been ever, well, at least in the last 40 years.
That's right. Yeah, and this chart shows how the interest rate increases that the Fed has, done over the last year and a half have really just not had the effect, the intended effect, or at least the historical effect that they'd had in the past by slowing the economy down in that sense.
So if you've got corporations doing relatively well, right, and you've got all this cash out there, okay, and sure, I mean, they could buy back, which means then, I mean, you've got some issues there, because if they're buying back stock, that's making the denominator of the whole calculation of earnings per share look different.
Outstanding shares decrease, right?
Good for stocks, right? I mean, you could read that as good for stocks. Here's the thing, though. I mean, the Fed's still out here trying to, they've paused, but now we're at a point where you've got full unemployment. You've got corporations with a ton of cash. I mean, Josh Brown has a number of times made the comment that, cash on corporate balance sheets actually inherently is inflationary.
Stimulative almost.
Stimulative, right. And I know there have been folks that have kind of poo-pooed that comment, but I think it's right. I think it's right. And I think some of it's showing up in this next chart. I mean, you're starting to see sort of, hey, I mean, if things are going to be good, okay, and you've got full unemployment, I mean, you're still sub 4, and you've got all this cash on corporate balance sheets. I mean, I know the Fed's trying to get to 2. And I mean, forever we said, everyone said, hey, how much do costs go up a year, right? 3%, right, on average.
Kind of the planning metric, right?
Correct. I'm starting to think that 5 is, or at least lately 5's been more the number.
It has.
So here's the chart. I mean, you can kind of see a little bit of a reversion in terms of median CPI, mean CPI, et cetera. And by the way, you can go out. Next chart, this is from the Cleveland Fed. Go to the Cleveland Fed and just watch this. And we've drawn these blue lines on the chart. But you can kind of see in that bottom left-hand side, everything pre-2021 was sub 3%. It didn't matter how you sliced and diced your inflation calculation.
That's right.
And now the Fed's been working to get the genie back in the bottle, right? And look, at some point soon, that green line there, the headline CPI, it's going to drop back beneath 3. But everything on the left of 2021, that looks to me like the inflation genie's in the bottle, right?
That's right.
Everything to the right looks to me like it's maybe not in the bottle.
Yeah, that's right. That's right. So, yeah, I mean, honestly, we've talked about corporations, but households as well. If you've got that much cash earning good interest rates, it's stimulative.
Yeah, how is it not stimulative? Right. Yeah. So Charlie Bolello shared this. Look, I mean, U.S. wages up 15% in the last 3 years. Okay, that's 5%, right?
That's right.
Okay, and some costs are lower, but most of the costs on that page are vastly above 15% in the last 3 years. So this was kind of interesting. You went out to the BLS calculator, which is the Bureau of Labor Statistics. Is that right?
That's correct.
Okay. And so tell us what you found.
Yeah. So this first chart shows the inflation since 2020. And it shows that, from December 2020, $100, it would require you $118.41 to buy what you could have bought back in December of 2020 for $100. So I got a little interested in looking at how long it would have taken previous to this inflation kind of tear that we've been on to have that same effect. And lo and behold, it took 10 years from January of 11 to December of 2020 to get to about the same number. And we've seen that all condensed now in 3 years.
Right. So the previous 10 years had a 1.7% unemployment rate, and the last 3 years had annualized inflation of, call it 5.8.
Oh, that's brutal.
It is brutal. It's absolutely brutal. Okay. So, and you could be saying to yourself, well, all this is in the rearview mirror and everything. Not if that genie's not in the bottle. It's
That's
not.
right. And then there's a compound effect of, okay, going back to markets, what does the rates mean? And you found this great chart in showing how correlations between bonds and stocks are not acting like you would expect, right? I think the big takeaway for me, and I want you to explain this thing, but the traditional kind of retiree investor invests
60-40 portfolio. Yeah, 60 growth, 40 conservative. And it's like yin and yang, right? Like if stocks went down, prices of bonds went up.
That's right.
And you can see that in this chart. So what this chart is 100-day rolling correlations. All right, what is that? What that means is it's basically 3 months from 2002 until now. And the idea is when it's negative correlation means if stocks go down, bonds go up.
Zig versus zag, right?
That's right. So everything basically through, call it kind of that Great Recession time period and all the way through the last decade before 2021, in essence was, there was a buoy in your bond portfolio.
Mm-hmm.
Okay. Now what it's saying is that stocks and long bonds, TLT is probably the most common one.
20 years.
20 plus year treasury, okay, that they're more positively correlated, which means they move in the same directions. Okay, so why does that matter? Well, now, next chart, we've got the U.S. Treasury curve as of this morning, right? 5.4% on a 90-day, goes down to 4.25% on a 5-year, 10-year, and 30-year 443. It's upside down. It's still inverted.
That's right. Yeah. Something looks funny about that chart.
Correct. And when you look at the next chart, which is a normal looking yield curve. So if you ever went to the bank with like your, parent or grandparent, and you saw the CD board over there sitting in the corner, it would say 90 days will pay you, X, and then we'll pay you 1 year, which is more than the
X
90
plus
day.
Something.
Yeah.
Right.
And then the 5 years more than the 1 year.
That's right.
It's supposed to be positively sloping where you get more yield for the money. But it's still inverted. In fact, we're pretty close to the longest inversion that we've ever had.
That's right.
On the yield curve. Okay, so what does that mean? Well, if the Fed's not going to cut rates.
Well, I mean, so yes, this normalizes one of two ways, right? Either the long end, the longer duration bonds have to go up in yield, or the short end comes down. And early this year, there was an expectation that at least the Fed was going to start cutting the rates. That keeps getting pushed out. It's still on the table for sure. But what is the impetus for them to need to cut rates?
Right.
And then what does that portend then for the long end?
Well, I mean, look, so the Purchasing Managers Index is starting up, okay? There's never been a time period, if you look back historically, where the Fed is cutting rates when PMIs are rising, which means business.
Right?
Yeah, I mean, it is expansionary. Okay, so you've got an unemployment at near historic lows. You've got PMIs starting to rise, and I mean they could falter, but I mean they've seemed to be bottoming. It seems plausible, at least, that the long end of the bond market could be more challenging. Okay. And again, we don't know what's going to happen. I'm not implying I know. The question is simply, is the long end now going to rise? Because if the short end's not going to fall with that normal stabilization of the yield curve where short's earning less than long,
right,
then presumably, I mean, if everything's going to be good and hunky-dory and we're all going to just, the the market's going to continue
Great
higher.
GDP, low unemployment.
Yeah, right.
Yeah.
Like everything's perfect, right? Well, then shouldn't you have a normal yield curve?
I mean, I want to get paid more for lending money for a longer period of time.
Right.
It just makes sense that way. So yes, it does seem like that is a risk to the market. And back to that correlation,
Right.
If bond yields on the long end rise, the inverse effect is that the bonds themselves drop.
Go down
and
in
that's
value.
That's the correlation chart that we saw.
If there's a positive correlation between stocks and bonds, or bonds and stocks in this case, if bond prices are falling, that would imply, based on that chart, that stock prices may have turbulence
well,
or
right.
at least some pressure as well, right?
Yep.
Something to keep an eye on.
That's right.
All right, next topic. Nvidia does report on Wednesday night. That's tomorrow night. This is a chart from Bespoke. Thought it was fantastic. Nvidia reports earnings after the close tomorrow. Stocks reported an earnings triple play, which is a beat earnings estimates, beat sales estimates, and raise guidance on 4 Q4 earnings reports. So this is the fourth quarter they're reporting tomorrow night in a row, and 7 of the last 8. Yes, expectations will be high. So if we look at this next chart, I mean, they only missed on revenues one time, and that was in February of 2019. Their guidance was, pretty much in line. But even on raises back like in 2022 and 2021, the stock did go down.
It went down. That's right. And obviously there were some people that thought we were very negative towards that stock. Anything can happen, right?
Yeah.
Anything can happen.
That's right.
But the reality is, as risk managers, there is risk there,
Right.
even when they beat and raise.
Right.
So
Right.
something to be paying attention to there.
Yeah, we'll see. All right, so I finished True Detective Night Country last night, and it was good. It was good.
Kind of tailed off.
Let me just say that there are 4 episodes, and love Jodie Foster. She does get a
premium there.
high ranking for me, but Matthew McConaughey and Woody Harrelson are still leading with the first season.
Okay, all right. Yeah, we Angie and I watched Einstein and the Bomb.
Oh, cool.
Yeah, neat lesson. It's kind of dramatized, but it is all his words, either something that he was recorded saying or written that the actor playing him is saying. So it was pretty neat. And again, I had no idea how much of a pacifist he was, and that he regretted to the day he died that he contributed to the atom bomb. So it was really, really intriguing. So
interesting.
Yeah. Well, listen, everybody, thank you so much for watching. Again, thanks for those new subscribers. Hit a like, send us a comment. We'd love to hear from you, and we'll look forward to seeing you again next week. Thanks.